Welcome to the deep dive. So you sent over the Sainsbury's annual report for 2024, and we're going to dig into it.
That's right.
Yeah, the plan is to pull out the really key business and financial stuff, give everyone a clear view of, how they've been doing, where they're heading strategically, and what's next, all from this document.
Exactly.
We'll focus on the different parts of their business, the main financial numbers, and importantly, how they're planning to create value for shareholders without getting totally bogged down in every single detail.
Yeah. And it's a pretty comprehensive report. There's a lot in there. Financials, strategy updates on brands like Argos, Nectar, too.
Yeah.
Also, colleague investment, stores, sustainability, risk, governance, the full picture, really.
Okay, sounds good. Let's dive right in then. The business segments, they kick off with this food first strategy. Sounds like that's been working well for them.
Ye definitely seems to be the headline success story in the report. They state pretty clearly that profit and free cash flow actually beat their guidance, which points to, really strong performance in the core grocery business. They talk about record market share gains.
Record gains!
Wow. Yeah, suggesting they're winning over customers.
Yeah.
And accelerating volume growth through the year. So people aren't just spending more because of inflation. They're actually buying more items.
Right, that's a key distinction.
Absolutely. And they specifically mentioned this led to better profit leverage.
Profit leverage, meaning?
Meaning the extra sales are translating more efficiently into profit. Maybe better cost control, maybe the mix of products they're selling is more profitable. Their retail underlying operating profit hit $966 million, up over 4%.
Okay.
And they directly link that back to the strength in grocery, plus their cost-saving efforts.
Got it. Makes sense. Now, beyond food, they've got these other brands that deliver, they call them. What's the story there?
So that's Argos, Nectar, Two Clothing, Habitat, and Sainsbury's Bank.
Yeah.
The idea over the last few years was to refocus them, make sure they're not just standalone businesses, but actually support and boost the main food operation.
So integration is key.
Yeah, exactly. The report says they've made good progress, but they're also upfront that there's more work to do. It's an ongoing thing.
Let's talk about Argos specifically. It feels, very different from the old catalog shops. What's driven that change?
Oh, massively different. It's been a huge shift. The report details this move to being a digital-first retailer.
Right.
Integrating Nectar seems to have been vital there, probably for customer insights and loyalty. Plus, they've really worked on their delivery better same-day coverage. And the big stat, 70% of Argos sales now start online.
70%, that's huge. What about the stores then? Are they just click and collect points now?
Well, they're still really important, especially for collection. They say almost 70% of those online click and collect orders are ready for immediate pickup at over 1,000 locations. So it's that blend, isn't it? Online convenience, local pickup.
Okay.
And operationally, this has apparently made Argos more resilient, lowered the cost of serving customers. They mentioned taking over 3 percentage points out of the cost to sales ratio.
Which is significant.
Very. And improved core profitability. So the transformation seems to be paying off financially.
But they also mentioned this next level Sainsbury's initiative means the Argos work isn't finished.
Right. It suggests they know retail doesn't stand still, technology changes, customer habits change. You have to keep evolving. So next level seems to be about that continuous adaptation for Argos.
Okay. Moving on to their people. The report talks a lot about investing in colleagues. What are they highlighting?
The pay increase is pretty striking, a 50% rise since 2018.
50%, wow.
And becoming the first big supermarket, full choice one anyway, to hit £12 an hour nationally. £13.15 in London, aligning with the real living wage. That's a big statement.
Definitely sends a message.
And the total investment number, they quote, over $500 million in pay over 3 years, shows it's a serious commitment. They seem to believe that investing in their staff is fundamental.
Is it just about pay or other things too?
No. They also mentioned things like extending free food during shifts, more frequent staff discounts. It feels like a broader approach to making it a better place to work, perhaps hoping that translates to better service and lower staff turnover.
Makes sense. What about diversity and inclusion?
They set targets 3 years back for gender and ethnicity in senior roles.
Yeah.
The report is quite open, says they haven't hit all of them.
Okay, transparency is good.
Yeah. But they do point out progress, especially increasing representation for women, ethnic minorities, and Black colleagues in leadership. And they got recognized in that Times Top 50 list for gender equality.
Right.
And they say new targets are coming under next level Sainsbury's. So it sounds like the focus remains.
Good to see them acknowledge where they need to do more. Okay, physical stores. What's the plan there? Sounds like changes are afoot.
Yeah, They're planning to trim back the general merchandise range and the space it takes up in about 180 supermarkets.
Right, less non-food stuff.
Exactly. The thinking is to align the store offer more closely with why people are primarily there, the grocery shop. They expect this focus to mean better sales and profit returns from the space, especially by boosting the food sections. It's about optimizing that core supermarket space.
Okay, a tighter focus in the main stores. The report also mentions this smart charge EV network, electric car
Right.
charging.
Yeah, this looks like a pretty strategic investment. They're building an ultra-rapid EV charging network right there at their supermarkets. Launched at 40 already, more planned.
That seems smart, leveraging the locations.
Totally. People are already going there, often for a decent amount of time. It adds a service, fits with sustainability goals, potentially draws in EV drivers. Makes a lot of sense.
Definitely. Now, they mention these big initiatives, Save and Invest to Win and Next Level Sainsbury's. Can you sort of unpack what those are about?
Sure. Think of them as the overall strategic game plan. Save and Invest to Win was about cutting costs efficiently and then, crucially, reinvesting those savings back into making things better for customers. Next Level Sainsbury's feels like the next chapter of that. It's a 3-year plan focusing on really targeted capital investments.
Investments in what specifically?
Things like boosting efficiency, upgrading capabilities, technology, people skills, improving productivity, and ultimately driving growth. The end goal is clearly stated: deliver strong, sustainable shareholder returns.
Right.
And this is where they also flag that commitment to a progressive dividend and the new 200 million share buyback.
Let's stick with the saving side for a second. They aim to save £1 billion. That's a big number. How are they planning to do that?
It rests on a few main ideas. One is just straightforward structural cost reduction across the board. Another is investing in their tech platform to make it more efficient.
Automating things.
Yes, simplifying and automating processes where possible, and also making sure the overall organization is the right size and shape. Basically, becoming leaner and more agile.
Okay. And how does sustainability fit in? They mentioned Plan for Better.
Right. Plan for better isn't separate. It's meant to be woven into how they do business every day.
Yeah.
Trying to get good commercial results and good sustainability outcomes.
Like what? Any examples?
A big part is building a more resilient food system. That means stronger supplier relationships. They mention things like giving potato suppliers more predictable margins or supporting living wages for banana workers through fair trade. So it's environmental and social ethical supply chain stuff.
Interesting. So it connects back to the core business. What about the non-food stuff again? General merchandise, clothing. We know they're reducing space, but how are those areas doing?
Yeah, they're definite on tightening those ranges. With clothing, they say the sales mix has actually become more profitable over the last 3 years. More full-price sales, fewer markdowns, better margins, higher average selling prices, less leftover stock.
It sounds positive overall for two then.
Generally, yes. But they do admit the last year, especially the final quarter, saw some underperformance because they had stock shortages. So they're taking action there. It shows even in areas with positive trends, there are still bumps in the road.
Always challenges. What about food waste? Retailers are always under pressure on that.
They are definitely working on it. They mentioned their partnership with Olio, the food sharing app, to redistribute surplus food.
Mm-hmm.
And they're trialing ways to repurpose waste, like turning it into animal feed. The report shows reductions in waste going to anaerobic digestion, although they did have to restate some past figures due to a reporting error.
Yeah.
So progress, but also focus needed on accurate tracking.
Right. Loyalty's huge now. Nectar, what's the plan there?
Big ambitions for Nectar. They want it to be, quoting here, sort of a world-leading platform, more personalized, more engaging, rewarding, transparent.
And the financial impact.
They're projecting it will contribute an incremental $100 million in profit over the 3 years to March 2027. So they clearly see big potential in leveraging that customer data and loyalty.
$100 million extra profit from Nectar. Okay. And back to Argos one last time. What's the forward strategy there, summing it up?
It seems to be about playing to its strengths: curated range, convenience, value, and improving profitability by continuing that operational shift. Fewer standalone stores, more Argos concessions inside Sainsbury supermarkets. That integration is key.
We've touched on various sustainability bits. Any other operational examples worth mentioning?
Yeah, a few. Integrated refrigeration and heating systems in stores for energy efficiency. That Long Hill Burn Wind Farm project has interesting potential to supply up to 1/3 of their electricity.
Wow, 1/3.
Potentially, yeah. And using more double-decker trailers for logistics to cut down on lorry journeys. Little things that add up.
Definitely. They also briefly mention valued behaviors. What's that about?
Those seem to be their internal cultural pillars. Things like taking ownership, being proactive. They say these behaviors are linked to performance reviews and career development, trying to embed a certain way of working, I suppose,
Right, shaping the culture.
and relationships beyond the company, suppliers, communities.
They stress how vital good supplier relationships are for that resilient food system we talked about. And they acknowledge their role in communities, especially with the cost of living pressures and food insecurity being major issues, plus engaging with government on regulations and things like that.
Okay. And finally on this section, climate change and net zero. What are the key commitments?
They're investing in tech to cut emissions, better store insulation, partnerships with researchers like Imperial College, even working with Williams Advanced Engineering on innovation.
Mhm.
The EV charging network fits here, too, plus the plan to shift their whole delivery fleet to alternative fuels by 2035. They've done climate scenario modeling as well. The big targets are net zero in their own operations by 2035.
Okay, that's quite soon.
Yeah. And net zero across the whole value chain scope 3, so suppliers and customers too, by 2050. These targets are validated by the Science-Based Targets Initiative, which adds credibility, and they're pushing suppliers to set their own targets. Okay, that's a really thorough look at the business operations and strategy. Let's switch gears fully to the financials now. You mentioned the underlying profit earlier, but walk us through the key highlights again.
Sure. So retail underlying operating profit, $966 million, up 4.3%, driven mainly by strong grocery performance and cost savings, which was needed because Argos was a bit softer and financial services had a weaker year.
Right.
Group underlying profit before tax was $701 million. That's up only 1.6% because higher finance costs ate into the retail improvement.
And the statutory profit,
Sure.
the bottom line number.
That was down quite a bit. Statutory profit before tax came in at $277 million, down over 15%.
Why the big difference between underlying and statutory?
Mostly due to what they call non-underlying items. The biggest one seems to be impairment charges related to restructuring their financial services arm.
Okay, so financial services is dragging down the statutory number. What's happening there?
Yeah, the report flags it as a weaker contributor compared to last year. They're actively restructuring it. They sold off their mortgage book for $446 million, for instance. That sale resulted in a non-underlying charge hitting the statutory profit.
Right. What about cash flow? Always crucial.
Retail free cash flow was $639 million, pretty much flat year on year, which is decent. But the big news was on debt.
Ah, yes, debt reduction.
Big reduction. Net debt, including leases, down by $790 million to about $5.5 billion. That shows strong cash generation from the core business, plus the impact of that property deal, the Hyper Dragon one.
So core retail is throwing off good cash, allowing debt pay down despite the financial services issues. How did earnings per share look?
Underlying basic EPS was 22.1 pence. Basic EPS was 5.9 pence. Both were lower than they might have been because the UK corporation tax rate went up.
Ah, okay, the tax impact. You mentioned that Hyper Dragon property deal contributing to debt reduction. Remind us what that was.
Right. They basically bought out a property investment vehicle they were part of, costing £731 million, including redeeming bonds. It involved 26 supermarkets they were leasing.
Oh, they own them now.
They own 21 of them outright now. They sold and leased back 4, and 1 was held for sale. So it simplifies things, gets rid of future lease payments on those 21 stores. A big strategic property move.
Gotcha. Any other cash flow statement details that jumped out?
Well, the adjusted retail underlying operating cash flow before working capital changes was strong at $2.156 billion, up on the year before.
Okay.
They also had a positive working capital movement, $262 million inflow, mainly because they held on to cash owed to suppliers a bit longer, increased payables. There were some cash costs for restructuring, like closing Argos in Ireland, about £72 million, and pension contributions were steady at $44 million. Overall, yeah, the cash flow picture for retail looks solid.
Okay, so resilient core, managing challenges elsewhere, generating cash. Let's talk shareholder value. Dividends, buybacks, what are they promising?
This is pretty clear-cut in the report. They're committing to a progressive dividend policy starting this current financial year, 24-25.
Progressive meaning?
Meaning aiming to increase the dividend payout over time, not just keep it flat. For the year just ended, they paid out $306 million. And importantly, that was covered 2.1 times by their free cash flow.
So plenty of headroom there. Safe dividend.
Seems sustainable based on that coverage ratio, yes.
And the buyback.
They've announced they're starting a 200 million share buyback program over the course of this year.
Okay. What's the goal of a buyback?
It reduces the number of shares out there. So, all else being equal, that boosts earnings per share. It's another way, besides dividends, to return cash directly to shareholders and potentially support the share price.
Right. So dividends growing over time plus buying back shares. A clear message to investors.
Okay, looking ahead then. Based on everything in this report, how do you assess Sainsbury's position moving forward? Well, that next-level Sainsbury strategy is obviously central. They believe these focused investments in efficiency, capabilities, and growth will deliver strong shareholder returns over the next 3 years. That's the plan. They'll be watching their KPIs, their key metrics, very closely to see if they're hitting the marks against those strategic pillars.
What about risks? What are they worried about?
The usual suspects are their data security, keeping up with regulations, product safety, plus specific risks around Sainsbury's Bank. The general trading environment is always a risk, too.
Any emerging risks they highlight?
Yeah, climate change impacts and cybersecurity threats are explicitly mentioned as emerging risks they're monitoring. And of course, the changes they're making in financial services bring their own execution risks.
And who oversees all this? The governance side.
Standard corporate structure. The main board sets the direction, and they have committees underneath: audit for financials and risk, remuneration for pay, nomination and governance for board matters, and a specific corporate responsibility and sustainability committee. They're all meant to provide oversight and ensure things are run properly.
Okay, so let's try and boil it all down. What are the main takeaways from this deep dive into the 2024 report?
One, the core grocery business is performing strongly and is really the engine of profitability right now. Two, Argos is undergoing a major ongoing transformation to fit the digital age. Three, they're making substantial investments in their people and in sustainability. Those aren't just side issues. And four, there's a clear plan to boost shareholder returns through that progressive dividend and the new share buyback.
It's a solid summary. Okay, here's a final thought to leave people with. They're making these big shifts in financial services, cutting back there, essentially, while also setting really ambitious net zero targets. How do you think Sainsbury's will balance that? You know, the pressure for short-term financial results versus these really important but perhaps costly long-term strategic and, frankly, societal goals, especially in such a tough retail market.
That's the multi-billion-pound question, isn't it?
It certainly is something to keep an eye on as they move into this next level. Right, thanks for walking us through that report.
My pleasure.
And thanks everyone for joining us on the deep dive.